Hi, this is Cyr, and I'm giving you a video today about investing in bonds. Lately, a lot of our clients have been investing more and more bonds given the current volatility of the stock market, and today I want to show you exactly what investing in bonds might look like. When we talk about a bond, we're talking about investing money into a company, essentially loaning them your money. When you loan the company money, in return, they are promising you a periodic payment of interest. At the end of the bond's maturity, you'll receive the final interest payment, and in addition, you'll receive your initial investment back. A bond generally is considered to be a more stable investment, and I'll show you some of the reasons why. One of the things about investing in bonds that people don't generally understand is that bonds fluctuate in value. It doesn't make sense on the first look because you're giving your money to a company, you're getting a fixed set of periodic interest payments, and then at the end you're getting your final payment, and then you're receiving the maturity back, you're receiving your initial investment back. So why would a bond fluctuate in value? And the answer is given most easily by this simple example. Suppose you buy a bond from McDonald's. McDonald's takes $10,000 of your money. This is your investment. And in return, they promise to pay you 5% or $500 a year. At the end of the bond's maturity, McDonald's promises to give you back your initial $10,000. You are generally happy about this investment. You're making 5% after all. Why would this bond fluctuate in value at all? Imagine you buy this bond and then the next day you want to sell it to your neighbor, or you want to sell it to your aunt or your uncle. You can easily sell this bond and your aunt or your uncle or your neighbor probably will be just as happy to have this bond as you were when you initially purchased it. However, all of a sudden McDonald's makes a decision and they decide that all new bonds they issue will now pay 6%. All of a sudden, your 5% bond is not attractive to your aunt or your uncle or to your neighbor. Why? Because your neighbor can buy a similar bond from McDonald's, and instead of getting 5%, they can get 6%. Your bond no longer has the same value it did when you bought it because of the change in their interest rates. This is an actual example from an actual client. This client owns two bonds. The bonds are worth $37,000. The next month, their statement came out, those two bonds fluctuated in value down to $35,000. Literally, the value of these bonds changed and went down by $2,000. Bonds can fluctuate in value. This is an idea of what I'm talking about. This red line is 2018 and shows the overall value of bonds throughout this 12-month period. You can see that in 2018, generally, bonds declined in value. Bonds can fluctuate in value. A little bit about a bond, we talked about the guaranteed interest rates. Well, they're not guaranteed. General Motors, once the biggest company in the world, went out of business. Chrysler Motors went out of business. Sears and Roebuck went out of business. Sometimes good companies go bad. Bonds issued by those companies lost value. In fact, in some cases, lost all of their value. So it's important to realize a second thing about bonds. Bonds have ratings. We want to invest in companies that have high ratings, generally an A rating. An A rating is called an investment grade bond. By the rating company's perspective, these companies with A ratings generally will be able to give you back your initial payment that you initially gave them. You should generally expect to receive this back. Oppositely, we have non-investment grade bonds which have more risk. So let's review so far. When you are a bank, you're basically giving money to a company. You, when you invest in a bond, are acting like a bank. You are giving a company money in return for interest. At the end of the period, you receive your investment back that you paid, and you also have to realize that the value of the bonds will fluctuate. Therefore, we want to hold bonds to maturity. We don't care if bonds fluctuate in value so long as we are holding the bond until the end of the period. We want to hold the bond to the end of the period. Therefore, we don't care about the difference in value. The second thing we've learned is that the creditworthiness of the issuer is critical. Investment grade bonds are a better investment because they generally are better quality companies. We want to buy investment grade bonds most of the time. Now we want to talk about how we might want to invest in bonds in Cyr Financial. This is not a commercial for Invesco, and this is not a commercial for Cyr Financial. This is just a video to share with you how we at Cyr Financial, at our firm, invest in bonds. Invesco is a company that offers us some features that we otherwise might not have. Imagine investing in bonds. We would never want to put all of our eggs in one basket. Therefore, we would like to see a client with 100 or 200 bonds in their portfolio. Managing hundreds of bonds at a time for hundreds of clients is virtually impossible. One way that we see a fit for our clients to invest in bonds is to use Invesco's bullet shares. They offer us four things. They allow us to invest in hundreds of bonds at a time, which you'll see later. They allow us to hold bonds of similar maturity dates until the end of the maturity date. They allow us to sell these bonds. So just like a regular bond could be sold to your aunt or your uncle or your neighbor, you can always sell these bullet shares in much the same way. They are considered to be highly liquid. Finally, the investments themselves, the picking of the hundreds of bonds, is done by a professional company on our behalf. I'm showing you two examples. These two examples of bullet shares are the 2021 examples. On the left-hand side, we have our investment grade bullet shares, or investment grade 2021 investment. On the right-hand side, we have the 2021 non-investment grade. The thing to point out in this chart is that the investment grade bonds are yielding approximately 3.5%. Generally, that is the expected return you might want to get, or you would expect to get, if you hold these bonds until 2021, an annualized return of 3.5%. Oppositely, the non-investment grade bonds are paying almost double, nearly 7%. Why wouldn't everybody want the 7% product as opposed to the 3.5% product? Again, the non-investment grade bonds are issued by companies that may not be as stable as the investment grade issuers. 3.5, 7, it's a balance. Generally, our more aggressive clients that invest in bonds may have more allocation to the non-investment grade 7% bonds. Generally, our conservative clients will have more allocation, or all of their allocation, into the investment grade bonds, earning a modest 3.5%. It's a risk-return trade-off. The only thing to show you on this chart, the investment grade product, the bullet shares 2021 product, has 396 bonds. So when you buy this product, imagine you invest $10,000 into this product. That means that you hold 396 bonds, but you only have $25 invested in each bond. So it's very diversified. The clients in this product have almost 400 bonds, a very diversified basket. And the non-investment grade has 158, a very diversified holding, a basket of bonds. This chart, though, reminds us that even the bullet shares, much like a regular bond fluctuates in value, so too does the bullet shares. This is 2018. The blue line is the fluctuating investment grade product. The red line is the fluctuating non-investment grade product. I love this chart. We are investors. Over the long term, stocks make a lot more money than bonds. This chart shows you that. I am still looking at the bullet shares product. I am looking at the actual performance of a 2018 bullet shares product. It was issued in 2012. Had you invested in this product in 2012 and held it to maturity, the return on the bullet shares 2018 product would have yielded you about a 5 to 8% product. You will notice, as we spoke, Bonds fluctuate in value. Although there's a little fluctuation, you can't see it, it does fluctuate from time to time. Bonds fluctuate in value. If you hold them to maturity, you should expect to make a good return. In this case, 5 to 8%. At the same time period from 2012 to 2018, had you instead invested in the stock market, you would have made 76%. Again, a good comparison and contrast to stocks and bonds. Stable, 5 to 8% return. Roller coaster, 76% return. Now, I want to shrink this chart down to just 2018 so you can really get a good picture of why bonds might be a good stable investment, and perhaps this will give you a better appreciation for bonds. 2018, as most of us know, was a pretty bad year for stocks. In fact, it was the worst year for stocks in a decade. This chart is shrinking down to just 2018. In 2018, the BulletShares 2018 product made approximately 3%, including interest. The stock market at one point had lost almost 15%. Therefore, in 2018, if you were a holder of this product, you were very happy not to be in the stock market. So over the long term, you're going to make a lot more money in the stock market. But in certain times, our dynamic strategies might allocate more to bonds, and the reason they would do that is because of what we saw in 2018. So in summary, bonds fluctuate in value. Bonds are only as good as the issuer that issues them. So when we buy a bond, we hold to maturity and we try to buy bonds that are investment grade. And finally, Invesco BulletShares offer a unique way to invest in bonds. Thank you very much for your time. I hope you appreciated this video.